Nicholas tires of the complications of investing across a smaller exchange in Canada. He realizes that larger stocks on the United States exchanges offer more safety. Nicholas sends in account open papers. Opening a new account in New York makes Nicholas feel like he's moving up on the financial front. He was engaging in something respectable. He decides to shun the kind of gambling he did in Canada. He decides to move more slowly, study more carefully, and be less impulsive in his interactions with the stock market. He counts his stake. He began with $11,000 that included $3,000 invested in Breland and profits of $8,000. Over 14 months in Canada, his $11,000 had eroded to just $5,200. Nicholas saves up $4,800 from show business activities to around his stock investing bankroll to $10,000. Darvas casually asks his new broker, Lou Keller, what was good. Lou recommends several fundamentally safe stocks because of share splits, increases in dividends, or higher earnings. His broker only suggests. Giving orders to his broker makes Nicholas feel in command and important. Here are 3 typical consecutive deals he concluded in the early part of 1954. Deals which convinced him that he was a natural on Wall Street. And in this table, as in all of the tables I'm going to show you in this course, commissions and taxes are included. Now, note that each of these transactions netted over $400. It was not a large sum, but 3 profits in a row amounting to $1,333.38 in just a few weeks made Nicholas Darvas feel that these were smooth, simple operations and that he was in control. Here are some more of his transactions during April and May of 1954. Profits, profits, profits. His confidence was at a height. This wasn't Canada. Here, everything he touched seemed to turn to gold. By the end of May, his $10,000 had grown to $14,600. He continued to trade continuously. He was frenetic. Sometimes he phoned his broker 20 times a day. And if he didn't conduct at least a transaction a day, he didn't feel like he was doing his work. This table of transactions around the time of July 1954 shows you how much energy he was putting out for very, very, very low returns. His net profit was $1.89. There's a saying that goes, don't confuse brains with a bull market. Nicholas has no idea that he's right in the middle of the biggest bull market in the world. This had grown over time after the great crash a few decades before. He notes that it's very easy to profit because of this bullishness. Movements in the stock market index explain a third to a half of the return in any given stock per the Carhart 4-factor capital asset pricing model. Now you can see this by looking at the adjusted R-squared values in the model that range between 0.3 and 0.5 for the market index factor. He makes profits on 3 deals in a row, making him feel like a natural in Wall Street in 1954. A fast $1,333.38 in a few short weeks in the first quarter of 1954 makes him feel like a superstar. Smooth and simple, they gave him the illusion of control. This masked the fact that his new approach was no better. After all, a broker's advice is professional information and not a tip. The information he was receiving he views as pure economics and no fluff. Impulsiveness almost destroys his chances of stock market success. He was making profits everywhere and had high confidence. Unlike Canada, he felt like Midas on Wall Street. He builds a portfolio worth $14,600 from his $10,000. A bump in the road now and then did not bother him. He patted himself on the back when he made money. Darvas blamed his broker when he lost. He traded continuously. He pestered his broker up to 20 times a day. He bought stocks the way a toddler reaches towards a store shelf from inside mom's shopping cart. He clears $1.89 after all this busy activity without accounting for his phone bill. And this is not the only thing nagging him. Nicholas doesn't understand the financial vocabulary spoken by his stockbroker. This puts the dancer back to the books. He studies concepts of capitalization, dividends, earning, per share earnings, assets, yields, bonds, stocks, and profits are analyzed conceptually. The vast written knowledge inspires Nicholas. He starts to discern data quality with care. He continues his quest chronicling, after all, somewhere there must be a big sound Wall Street stock that could do as well for me as what I now consider a little penny stock. He subscribes to Standard & Poor's, Moody's, and Fitch's rating services. He understands little except that they were highly respectable sounding, but did not tell him which stock would actually rise. Darvas begins reviewing other sources of stock market information off of newspapers, newsletters, and book jackets. He subscribes to every service he could find or could find him by mailing list. Even today, financial newsletter marketers such as those in the Oxford Club maintain these lists. He was astonished to discover that services were highly contradictory. One service wrote sell, while another wrote buy. These were done in the most arm's length wording, designed to protect the editor or publisher rather than Nicholas Darvas. These writers expressed themselves in vague language such as should be bought on dips or buy on reactions. Not one service explained exactly what a dip or reaction was, but he was hooked to what was in reality diatribe to his account balance. He ignored the signs in his haste to find stocks that only rose. Nicholas Darvas is on the mailing list of the biggest advisory services on Wall Street. These publish glossy and expensive booklets on a stock 5 or 6 times a year. Darvas did not understand the contents, but he was deeply impressed by Emerson, which one report explained should be, but was not, worth between $30 and $35 a share. The stock was going for just $12 at the time. Nicholas buys in at 12.5. His surefire glossy play begins to drop. This perplexes him and he sells. By the end of 1956, the stock hits 5 3/4 with no bottom in sight. He still believes that whomever created the glossy report held nothing but goodwill for his readers. Over time, he learns that stocks recommended by advisory services tend to drop. In his studies, he reads the Wall Street saying, "You cannot go broke taking a profit." He buys shares of Kaiser Aluminum. It's 1955 in February. He jumps to Boeing. The stock drops. He hops to Magna Copper. This change of trades generates a net loss of $461.21. But Kaiser Aluminum rises all along. Darvas gave up $1,748.75 that he would have made sitting put in Kaiser Aluminum, doing nothing. Fidgeting for action churns Nicholas's account. He dances in and out of stocks. Rayonier soars from 50 to 100 in just 8 months. This would have landed him profits of $2,612.48. Rather, he nets $195.02 from $2,417.46. Buy low and sell high sounded a lot better than you cannot go broke taking a profit. But he had no idea where to find cheap stocks. Then he stumbles on the over-the-counter market. These are not well regulated. They're not listed. Not many people recognize these companies. He subscribes to Over-the-Counter Securities Review Monthly. Nicholas purchased shares of Pacific Air Motive. It was unknown even at the time. Another obscure startup was Collins Radio. Gulf Sulphur was some strange chemical company. Another unlisted fly-by-night was Doman Helicopter. Kennametal was a resource company that nobody knew of except Darvas. Then there was Tech Oil Corporation that never rose above ground. And he buys other even lesser-known stocks. Darvas has a hard time selling these stocks. These stocks are hard to sell even at its entry price. This is because the bid and the ask are at very different levels. He may try to sell for $42, but can only get somebody else to buy at $38. Investing in stocks over the counter is only for those specialized to do so. He decides that OTC trading is not profitable for him. He eventually attributes a lack of profitability to a lack of specialists to ensure a fair and orderly market. Notice that it's the same OTC market that Froster Jordan Belfort used to become the Wolf of Wall Street as portrayed by Leo DiCaprio. Darvas returns to high liquid listed stocks. Nicholas learns the hard way to avoid Wall Street's rumors. He hears of an atomic train under construction by Baldwin Lima Hamilton. Shares soar from $12 to over $20. Darvas enters at the apogee for $24.25. 2 weeks later, he bails out at $19.25. The dud falls after that to $12.5. He realizes that despite this rumor, something is wrong. Lou Keller calls and says Sterling Precision will go to $40 before the end of the year. It was trading for $58. He says the company is buying up smaller, prosperous companies and will grow into a giant in no time. The broker needed to say no more to pull Nicholas in for 1,000 shares at 7 7/8 for $8,023.10. It drops. Something is clearly off. He gets out at 7 1/8 for $6,967.45. Listening to gossip cost Nicholas $1,055.65 in less than a week. He decides that if gossip doesn't help, then maybe actual transactions of insiders will through the SEC Insider Transactions Report. This fails for Darvas as well. Too much time has passed when he learns of their trades for insider stocks to rise. Otherwise, most of the insiders made bad trades. He decides that managers are paid to know about their businesses and industry rather than the activity of speculation in the company's stock. He lays out 5 core rules. His first rule is don't follow investment newsletters. His second rule is shun broker advice. His third rule is disregard Wall Street lore. His fourth rule is do not trade across the OTC. His fifth rule is ignore gossip. Our research on the Insider Alert newsletter covered in Do Investment Newsletters Move Markets that was published in Financial Management shows that insiders are incapable of forecasting stock movements in the firms they manage, just as Nicholas discovered years before. Darvas suspects that the Virginian could be the clue for cracking Breland Mining. Nicholas Darvas picks up 100 shares of Virginian Railway stock at 29 3/4 for $3,004.88. This is in August of 1994. The dancer ignores it. The stock pays a good dividend and has high earnings, making him $1,303.68 after selling out for $4,356. From this success, he develops his 6th rule, study earnings and dividends. And then his 7th rule, buy one hot rising stock rather than frantically follow a dozen. From that idea, Nicholas Darvas starts to discern earnings quality, writing, I thought that if I really studied the company reports, I could find out all about a stock and decide whether it was a good investment. Fundamental concepts from the balance sheet, cash flow statement, and income statements become the norm in his stock chats. Nicholas ups his analysis a notch or 3. Darvas goes on a spirit quest for the perpetually rising stock. He uses value line lists to filter by quality, analyst view, cash position, and dividend payout. But no matter how right everything seemed, the stock dropped. Lou Keller recommended that Nicholas Darvas subscribe to a service that gave data on a couple of thousand issues as to business model, decades of historical prices, capital structure, EPS, and a service unique rating for value and safety where AAA was safest. This made everything easy. There was no reason to comb through income statements or balance sheets. The path was clear. A was greater than B was greater than C. He felt cool-headed like James Bond, organizing his data into tables for hours on end.